Good morning, everybody. My name is Lee Schwartz. I am the Business Development Sales Manager for SVA, and we're going to get started here. I want to thank everybody for coming. This is a huge topic for us. Interestingly enough, I was here actually last week introducing Nikki and some other folks on a similar topic, and it was a little bit of an easier introduction to do because it was the day after Halloween, and everybody's got Halloween in common. So we were talking about the issues of having to deal with all the extra candy and maybe eating a few extra pieces of candy. Dealing with the morning after the election is a little bit harder. But here's one thing I can tell you, and having some conversations here already this morning, I think we can all agree and all be excited for the end of political advertising on television. So there we go. We can at least all agree on that. You know, we are celebrating our 45th year in business next year. And what I think is so great about SVA is our vision is to remain an independent regional professional services firm. That's really important to us because in our marketplace we've seen, and to give you an idea, I've been with SVA for 7 years, and we have seen a lot of consolidation in our industry. And the consolidation tends to happen because oftentimes companies don't go through a process of succession planning, and eventually they want to exit and they end up selling, and that's okay. I think what we can all agree is that there's an added level of planning that is important in order to give yourself a few more options. I wanted to introduce some of our folks today. We've actually got two different groups. Look at you guys. You're on different sides of the, I'm not trying to separate them, but we're kind of co-producing here from the folks at SVA. On this side of the room, we have Nicole Grollup and Nancy Melberg from our CPA firm. And on this side, we have Tim O'Brien and Jamie Dressler from SVA Plum Financial. So they're looking at this from two very different perspectives. So let me take some time and just give you a little bit of background on each of these people. Nikki is, again, in our CPA firm and is a principal and CPA and works with a diverse group of businesses and leads our succession planning practice, particularly in the Madison area. I can tell you, Nikki and I have worked very closely on a bunch of clients here recently, and both she and Nancy really bring this very unique ability to be able to have the strong technical knowledge, but also that difficult piece of bringing together different generations, which is really important in this process. Nancy is in our Brookfield office, and again, really focuses on succession planning and has a wide kind of book of business, if you will. She's also one of our certified value builders, so she helps companies really build value in their business before a potential transition or sale. On the SVA Plum Financial side of things, we have Tim O'Brien, who's one of our principals. Tim is got an interesting background, along with some background in the Air Force, which I always love being in his office because he's got neat planes around. He's got an MBA in accounting and finance. He's a chartered financial analyst, and he's on our investment team. So really high-level understanding of everything that's going on from a financial standpoint. And then Jamie Dressler, I was trying to think about what to say about Jamie, and I asked him before, and what did you say? You said, go ahead.
These are muscle.
Yeah, I'm the muscle. I said, tell everybody I'm neat.
He said, I'm the greatest guy in the world. He's a good guy. I'll say he's a good guy. But Jamie's a wealth manager and has been with us for several years. Got an interesting background in mechanical engineering as well. So that's not something you see a lot in some of our wealth managers. So I think he brings a unique perspective here as well. So a varied background. We're going to cover a lot of different topics today. We're very excited that you're here. And with that, I am going to hand it off to Nikki.
Thank you, Lee. All right, so now let's get into some of the fun stuff, the reason why we're all here. So let's set the stage for what we're going to talk about today in our time together. So the first thing that we're going to talk about are know your objectives. So as you'll see throughout our conversation, there's some universal objectives, and then there's some objectives that are very individual and specific to you. Business risks. So how do you plan and prepare? So we did this presentation in sorry if there's some background. We did this presentation yesterday in our Milwaukee office, and really the key to the whole presentation is planning. Planning takes a lot of time. So you'll hear that come up a lot over and over again. Business value. So if the value isn't what you need or what is the value, you need to close the gap. And how are you going to close the gap? And lastly, we're going to go through family readiness. So are you and is your family prepared for this transition? Throughout the presentation, feel free to ask questions. Otherwise, we have time left at the end as well for some Q&A. So let's just go through some statistics to see, where are the majority of business owners at? And I think you'll be able to relate to some of these statistics. So any guesses on what percentage of business owners plan to exit the business in the next 10 years? Are there any guesses out there on what percentage anybody thinks that might be? Good, 79%. So 79% of closely held businesses plan to exit in the next 10 years. So why is planning so important? There are going to be so many businesses on the market that you need to be ready. What percentage of business owners that are planning to exit have talked to their family about the exit? So we know 79% expect to exit. What percentage has talked to their family? Any guesses? It's pretty high. It's 78%. So people feel comfortable with their family, so they probably talk to their family about it. But what percentage of people have anything in writing on how this is going to work, what it's going to look like, what their plans are? 10%. We got a 10. It's pretty close, 17%. So you're probably going to relate to some of these statistics, and this is, hey, you aren't alone here, and we're going to talk to you. If you haven't started, how do you get started? That's what we're gonna talk about today. So let's set the ground for what is an exit plan. So we're all talking about the same thing. So it's really a comprehensive plan. It includes a lot of different aspects. So you need to look at your owner objectives, and we'll get into those right after this. So what are your objectives for the business? What are your personal and your business financial resources? So what do you have? What do you need? After you figure those all out, you cannot begin down your exit path until you have those figured out. Once you have those figured out, then you talk about likely your business is your biggest asset. So how do you maximize that asset? And more importantly, how do you protect that asset? So at any given time, how do you make sure that that asset is protected? Do you want to sell to a third party or do you want to sell to an insider? So a lot of those comes from your objectives up above. You're hopefully going to just go down one path or the other. And you need to do different things. So you really need to determine this. You need to determine this before you start down the path. Business continuity. This isn't just for business owners that are looking to sell their business, but it's really important for any business owner. What's going to happen to the business if something happens to you? So that's a thought, but that really needs to be in writing so those people can take over. And then personal wealth and estate planning. So what do you have, what do you need, and what are you going to do with the assets after you sell the business? That all boils down into a written, comprehensive exit plan. So as you can see, there's a lot of different components that we're going to dig into deeper. So we talked about one of the first things you need to do is you need to know your objectives. So there are 3 universal objectives that every single business owner needs to think about and decide. You want to sell your business when you want. The when is really the reason why only 17% of people have this in writing, because quite honestly, it's scary. You're a business owner, maybe you've worked 30 plus years, 50 to 60 plus hours per week in your business. So now thinking about life after retirement is scary. So a lot of times business owners just don't want to think about it. They just focus on the business, focus in the business, on the business. So you really need to set a stake in the ground at some point. Now, that's hard to do when you're still relatively healthy, but ideally you want 8 to 10 years to plan for your transition. So you need to do that when you're healthy, when everything's great. Now, some of you in the room today might say, I don't have 8 to 10 years, and that's okay. It doesn't mean don't start somewhere. But you need to set that stake. So you get to that stake in the road and you're still relatively healthy, you still have energy, the business is still thriving, you can move that. You can move that a lot easier, but trying to accelerate that time frame is almost impossible. For the money you need, so need to determine how much do you need and how much is the business worth. A lot of times people think the business is worth what they need. In all actuality, those two have no correlation to each other and to the person you choose. So there's a lot of things you need to think about there as far as an insider or a third party.
So we always talk about in planning, what's your objective? And whether it's a financial plan, estate planning, or a business transition plan, we really start talking about, well, I want enough money to retire in. I want to know how much income I'm going to have. I want to maximize the value of my business, as Nikki was saying earlier. But this has probably been your life's work. You've put everything into it. So do you have other goals, other objectives that you want to meet on this? Do you have some sort of charitable piece that you really think is important? You know, there's multiple shareholders or stakeholders in this business, including your employees. So is this a business that you're going to maximize and sell it to a third party and they're going to close down different departments? Or do you have employees that you really think it's more important that that continues on? And you guys are major supporters in our communities. How does that continue if this business moves on? So it's not just about that one objective, maximizing the business. It's having that discussion that you're having with your family along the lines of what this business transition means for my overall family. And Nikki talked earlier about one of the big questions is who? Who are you going to sell to? So when you have this checklist in your mind, you should say, okay, would I sell to them? And the other checklist should be, would they want to buy it? So if you look inside, most of you, if you're going to sell your business, probably have some thought about moving it to either family or insiders. So are you ready to sell to them? Are they ready? Have you trained your insiders, your family members to be ready to take over that? We always hope or think about the strategic buyer because that's the person that's going to pay 2 times what you would for your family member. Is there a strategic buyer that you're going to take that 5 to 8 years to position yourself for? Or is there a competitor that would like to take you out to consolidate the market? And Nancy and I were talking about this the other day. Also, what about, do you have somebody that you're supplying to, you know, one of your customers that would like to take you inside of the business? So can you check mark, is there multiples of those or is there really one? Or in a lot of businesses, there's 0 and you are the business. So how can you plan to that you get to the right who on that part of it? That's really one of the critical questions as you're having these discussions, not just with your spouse, but with your advisors, like our group, or also with your employees. You know, there's 3 areas when you think about family business, right? There's the family conflict that you have between parents and kids. There's sibling issues. There's business issues. We're just trying to make a buck. We're trying to keep moving. There's the ownership part, who owns it, how do those dollars get moved around, do I only get paid if I work in the business? And there's an area where they kind of all converge, and it shouldn't be light blue, right? That should be red, because there's a hot spot there for almost everybody when they have to talk about it. And it's big issues. And as you guys are sitting here and thinking about business transition, it's a much bigger issue now than it probably was when you started your business. So you're going to meet Joe and Jane 15 years ago. You're going to see them show up throughout the presentation in different parts. But Joe and Jane, when they started the business, had a nice little business going, $300,000 of value in that business. They have 3 kids, probably one's in college, one's getting ready for college, one's in high school. Pretty straightforward if something happened to them, right? So fair and equal would probably be about the same deal. Business may not carry on. They get hit by the bus, you've got $300,000, you split it between the 3 kids, they move on for school, house, they move forward. You go 15 years later and you're here at 2018 or 19, and their business is now worth $4.5 million. You've got 1 kid in the business that's really almost running the business for you. You've got another child that's off in California, very successful, raising kids, and you've got a 3rd kid that may be in the business, but not really, but's kind of really living off the cash flows. You know, what is fair and equal in that situation? How do you deal with those things? Because this is a family business. And not only that, we're just talking about the family side of it. What do your customers think? What do your suppliers think? And, you know, what do your employees think? So, you know, you don't want to get in this environment where everybody says that there's 2 different tiers of shareholder, right? So that I'm working here, and if it transitions to the kid, I don't know that I really want to be around in this part of it. You know, so from this part, this family part of it, there's really 3 aspects that Nikki's going to cover on what to think about going forward. get at 1 point.
Magic.
Oh, I went backwards. There you go.
All right, so there's three things that you really need to think about. There's three areas that you need to be ready for. So timing is key. So you as a business owner need to be ready. So you need to think about, ready might mean financially, are you ready? Are you emotionally ready? The business needs to be ready. So Tim alluded to earlier, if you're a business owner and you say, hey, I have not taken a vacation in 20 years, I'm in. That's not really great for your business. That's not great for your business value. So you really need to, when you're thinking about getting your business ready, who can run your business if you're not there? That's key, because if you're it and you're going to retire, you are the business value and you're leaving. And then the marketplace. So we can control when the business owner is ready. You can control when the business is ready. But the marketplace is completely out of your control, out of our control. So what you need to do is you need to make sure that the things you can control are ready when the marketplace is ready. As I said earlier, 79% of business owners are looking to retire or sell their business in the next 10 years. What that means is there's going to be a lot of businesses for sale in the marketplace, so timing is key for business value and successful transition.
So you guys have all been in business probably for a long time, so what are some of the indicators that might say the market's ready for your business to be bought, not just that you're ready to sell it? If you go back to 1986 to 2019, this shows small business optimism. And if you're looking to sell your business from 86 to 2006, you were really in a zone, a range there that was fairly consistent, that people probably out looking for businesses. But in the Great Recession hit, people weren't looking to buy businesses. People were hunkering down and trying to survive. So you've had this nice recovery now that we're back actually at a peak. Does that mean is it time to kind of hunker down again and get ready? Or is this really one of the times that you should be thinking about looking to move your business? Because as we've seen out there, and you'll hear Nancy and Nikki talk later, people are looking to buy businesses right now. And I think this is one of the reasons. Also, we've got a fairly strong economy. I agree with Lee when he said one of the greatest things about the U.S. is this is the day after the election, and unlike a lot of countries, we just got up and here we are at a seminar and traffic's moving and we're moving right along. But again, in the Great Recession, you had the economy slow to 8% by 8%. That's overall. We made this presentation, Nikki and I, to a bunch of home builders. Do you think they were down 8%? No, they were down huge amounts. So are you prepared for that part of it? Or are now you just living in this fairly good environment for the last 10 years we've gone up? Now, we're not saying that there's a recession coming or anything like that, but it has been a fairly good environment for business. As you look to sell your business, more than likely the people that are buying your business are going to have to go get some money to buy it. They probably just don't have straight cash. Well, that's been a huge change too, right? If you go back to 2016, this is the 10-year Treasury over about 3 years. Interest rates were 1.5%. I don't want to say it was free money, but it was pretty darn cheap. Here we are today, and the 10 years over 3.2. I don't know if you guys saw the news on mortgage rates. So mortgage rates, although historically very low, just went over 5%. They are at an 8-year high. Mortgage applications are at an 8-year low. So, there is a real effect in there, and there's effect in your business. One of the other things I would tell you is you are probably mentoring the people that are going to buy your business. And one of the things that happens when the people that you're mentoring go to the bank to borrow money, a lot of them have crappy credit because they haven't paid attention to their credit score. So one of the things you can do to help the people that are in your business or maybe buying their business, make sure they keep their credit up so when they go to the bank's willing to lend them money at a decent rate. So we really think about in this business, I really like this slide. It works for financial planning, and it also works for business transition. What do you have total control over? What do you have some control over? And what are things that are completely out of your control that you're just going to have to react and adapt to? Well, in our business, you can control your spending and savings. Same with your business. You can decide where you're going to put your assets in your locations. Those are all things that you have total control over. how long you're going to work and how much money you're going to get, and longevity. I mean, we've had a couple of different occasions over the last couple of years where clients have come in and said, I just got the bad health report, and I want to be out, and I want to be out now. That's easier if you've been planning along that line. You don't have total control over that. You know, we've had some changes in control of House, Senate, just some things are going on there, so there'll probably be some change in regulations, and the same thing with the markets. So if you kind of think about this as either your retirement or your business, what can you control? I think it's a nice framework for what you're going to look at.
So as I said earlier, your business is likely, if you're like most people, your business is likely your largest asset. So how do you protect that? What are some of the risks you need to think about during this process? So one thing you need to think about is what would happen if something happened to me with the business. So that's a little different if you're a sole owner or if you're a co-owner. So if you're a sole owner, you might be it. Can your spouse jump into the business? Have they worked in the business? Do they work in the business? And what would they need to know that only is up in your head? So many business owners have all this information just twirling up in their head, but it never gets down on paper. So really the whole concept here is let's get it down on paper. But if you're a sole owner, if something happens to you, what's the first thing that happens with your employees? They become scared. They become wondering about what's going to happen to their future, so they start looking for a job. So one thing you can do to mitigate that risk, because you're going to depend on them likely to run the company. So those people you are going to depend on to run the company until your heirs can sell it, is a stay bonus. So a stay bonus says if something happens to me, I'm going to give you a bonus to stay for X amount of time frame. Usually it's 12 to 18 months to help the business before sale. So the stay bonus has to be communicated to your employees, so they have to know that it's there, otherwise they're just going to go look for a job. It has to be funded, so oftentimes the stay bonus is funded with life insurance or other reserves. So that's really important, and then it has to be written. So everybody has to know what it is and what's going to happen, but then it also needs to be substantial. So in order to get somebody to stay during a transition period, substantial is typically around 30%, give or take. So that's something that you really need to think about. How is the business going to pay for this? Continuity is a little different if you're a co-owner. So a lot of times I talk to business owners and I say, well, what happens if something happens to you? And they say, oh, well, my co-owner has it. We have a buy-sell agreement, everything's great. Okay, so first thing I say is, well, how dusty is your buy-sell agreement? And typically I find that that's got a pretty thick layer of dust on it. So then I start asking them questions on, when's the last time you updated it? Is it funded? An unfunded buy-sell agreement is really just a piece of paper. And does it address all possible transfer issues? So in your handout, there's a handout. This might be a little small to read, but there's a lot of different areas that you need to look at in your buy-sell agreement. So I'm just going to touch on a couple. I had a prospect, now a client, come and asked them for their buy-sell agreement. They dug it out of the drawer, and it was done 10 years ago, and it just had a dollar number. Never updated in the last 10 years. And I said, well, based on what I've heard from you, your business has changed a lot in the last 10 years. And they're like, yeah, it sure has. And I said, well, is your business still worth this? Absolutely not. So they're running a risk. If something happens to them, they're running the risk that that's the value they were going to get for the business. Another thing that I see quite often, another client has multiple different divisions of business. And the buy-sell agreement, really one owner isn't going to buy both divisions. It doesn't make sense. They're kind of very different. One's farm rental and one's actual operations. But the buy-sell agreement calculation encompassed everything. So, and there was no way to really break out what the value of one was versus the other. So that's really detrimental because those two areas, they shouldn't go to the same person. Self-financing. So a lot of times in these transactions, especially if you're selling to an insider, so selling to a family or key management, there might be some sort of self-financing element to that. And what that brings up is, you're going to do a financial plan. You know how much you need to retire, and you're probably going to rely on the business for that. So if you have self-financing, how do you limit that risk of, once you start stepping away, that you're still going to get paid for that? So you can look at some things like voting and non-voting stock. How do you remain in control of the business until your risk is down to a level that you can tolerate? What rates do you want to maintain? How involved do you want to be in the business? But then more importantly, if this doesn't come to fruition, if the business starts declining, are you ready to step back in and take over that business? And it's easy to say now, oh yeah, I've got it. But if you're in 3 years of a 5-year note payment, you've been out of the business for 3 years, it's going to be a lot harder to think about that stepping back in. Life insurance versus life events. So life insurance, there's a lot of different purposes for life insurance. It can fund estate taxes. Now we see that a little less now that the estate tax exemption has doubled. But we don't know what will happen in the future, so there's probably still a place for that. It can be used to equalize an estate. So maybe you have a business active child and you have a non-business active child. Does it make sense for that non-business active child to come into the business? Or does it make sense to do the fair some other way, potentially through life insurance? Could be collateral on bank financing. A lot of times we'll see the bank requiring some sort of life insurance. Can be used to fund a buy-sell agreement. Or you can have life insurance on a key employee. But the real pitfall in this whole thing is, what if a business owner becomes disabled? And they're relying on the life insurance to fund the buy-sell agreement, and your partner is not able to work. It's really an unfunded buy-sell agreement at that point of time. So you really need to think about, does your buy-sell agreement really factor that in, and how can you buy them out? What's the duration that you have to do that? Then you need to look at personal guarantees. So Tim alluded to earlier that some of the successors don't have the greatest credit history, or some of the successors just don't have a large net worth at this point in time. They're likely much younger. So are they going to be able to take on the debt, the guarantee? So a lot of times in family transitions, I'll see that the bank isn't necessarily willing to let the parents off, or the parents off of the bank guarantee. So then you might see a guarantee fee implemented or something to compensate for that additional risk. But what you really need to think about is, that's a short-term solution, but what is a long-term solution? So you don't want to guarantee this debt forever, so are you going to reduce the debt? Or are maybe the children or the management team, are they going to build their net assets, or somehow is there some negotiation with the bank on that? So you really need to think about not just the short-term, but the long-term impact of that. Also, we know that hiring's hard, and our key people are really taking us from point A to point B. So what are our golden handcuffs? I had a client that was looking to sell, and about 1 week before they were going to close the transaction, the buyer, who was also an employee, turned in their termination, turned in their notice, and they were no longer buying the business. So they had worked on that plan for a long time. So you really need to think about, how do you make sure that doesn't happen to you? Also key employees. So some people want to work, still be involved in the company after they sell the company, and some people do not. And if you do not, then you really need to rely on your key management team to be that value to the buyer to help the business continue. So you might need some incentives, and they could be stock-based or they could be cash-based. You could have a phantom stock plan. You could actually have stock purchase plans, but they need to be specific. They need to be in writing, so you and your employee know what's out there, and it's very specific. Everybody knows what's going to happen. What performance standards are going to trigger these? So they need to be earned. If they're not providing you the value, then you don't want to give them the benefit. And again, they need to be substantial. And we talked about earlier that about 30% is considered substantial to actually keep an employee on. Now Jamie's going to give us some insight on how we can use retirement plans in this.
Thanks, Nikki. So retirement plans, what we find, are often a less thought about tool in the process of transitioning your business. But if you think about a retirement plan for your business, it kind of has four competing factors. You can contribute a lot and save less in taxes, so you can save for yourself. You can pay less tax. Maybe you want to take advantage of the features that a retirement plan offers by helping you find a creative way to reduce the value of your business. It can also be a tool to help incentivize to keep your employees in place during the time of transition. So I hope to give you a couple of thoughts today about how a retirement plan could be a tool to maybe achieve some of those goals that might apply to you. So when you're thinking about a retirement plan, like I said, it's really a factor of competing interests. It's really easy to say, yeah, I'll just save more in my retirement plan. But along the way, there's rules and guidance that you need to follow in order to make sure that you're meeting the requirements of the both IRS and Department of Labor rules. But inside of that, there's a lot of leeway. You have lots of ways to decide how you're going to contribute: employer contributions, employee contributions, after-tax contributions, Roth contribution, pre-tax contributions. How can those work for you? You can save a significant amount, possibly, in your retirement plan, up to $61,500. So oftentimes, one thing you might consider is, if you're ramping up to sell, maybe you haven't been contributing to your 401k because you've been pouring all of your resources back into your business. Maybe this is the time to really maximize your contributions to your 401k for the last 3, 5, 8, however many years it might be that you still own the business. And in the process, increase the profit sharing type contributions that your employees receive to help, as Nikki was talking about, as a way to incentivize your employees to help them stay through the transition, okay? But like with all good things, you need to be careful that you don't step in the traps. There's testing requirements and other rules associated with how much you can contribute relative to your employees. And what I want to do is review an actual example for a client that we have that illustrates this. So generally, the more you contribute for yourself, the more you have to contribute or need to contribute for your employees. But like everything, there's a balance there to strike. And so using this example, we had a client come to us, and what you can see is on the very top of the screen where it says owner 1, owner 2, those are the spouses that own the business. And it outlines what their total compensation is of $275,000. The rest of the employees' total compensation is $700,000 and change. They came to us and they were deferring in total all employee contributions of $79,400. The employer was contributing about $29,000. Zero of it was going to the owners. Okay? Now, if you get creative with your design for your 401k plan or your retirement plan, what you can end up with is something that looks like this, down on the last half. The owners each have the same compensation. The owners' deferrals go up. The amount that the employer contributes to the owners, okay, also goes up substantially. But the difference is, in the first scenario, you were contributing $30,000 for all of your employees. In the second scenario, you're contributing a total of $71,000. So by agreeing or deciding to increase the payout to your employees by about $40,000, you're able to contribute for this family $72,000, $73,000 more dollars to yourself. So that's the trade-off that can occur. And we think it's something that you want to consider as you're thinking about your business transition. Okay. The other item to think about is the more you save when you're working, the less you need after you've retired to have the same standard of living. Okay? And so what this chart illustrates, and it's in your handout as well, is if you're earning $150,000 but you're saving $50,000 a year, I'm oversimplifying here, but then what you really need to live on after retirement is $100,000, because when you retire or when you sell your business, you're not going to continue to save any longer. So that difference is what we refer to as an income replacement ratio. And so having an idea of what that is for yourself and for your life after your business sale, we think is really important. business value. Nancy.
Thank you. So first of all, I tend to move around a lot when I talk. So if I get in the way of anything on here, please, somebody just push me, tell me move. So what I want to talk about is I want to talk about the gap. So you've heard us now in the last 30 minutes or so talk about this gap between what you need to retire and what your business is worth. And we sometimes call that the asset gap because there's a gap in that asset. So what I want to talk about today is I want to talk about how we're going to tighten that gap and how we can make sure that your business is worth what you need it to be worth when you're ready to exit. So we have some options if there's a gap. And the first option is stay and work. Don't sell your business. Now, believe it or not, I've actually made this recommendation to a client recently because when we looked at the W-2 wage he was earning, the S distributions he was taking out of the company, the benefits the company was paying, health insurance, company vehicle, cell phone, all those added up to a lot more than he was going to get if he sold the business and what he needed to retire. So we said, you know what, just stay in the business and work it for a while. Get a good management team in place to help you and stay there for a while. The other option is get what you can for it and change your lifestyle. You guys alluded to that a little bit earlier, that can you live on less? Can you sell that vacation home you have in Florida? Can you stop collecting cars? Yeah, I hear some people laughing here because, you know, sometimes I ask people, what are you going to do when you retire? And they say, I'm going to travel. Well, guess what? You're not going to live on less money if you're going to be traveling more. You actually need a little bit more. So you have to think about, can I change my lifestyle? And the third option that I'm going to talk about now is building that value. How can I take that biggest asset that I have and increase its value? What is this thing? Okay. So the first thing you're probably wondering is, how do I know what the gap is? I keep hearing you guys talk about this gap, but how do I figure out what the gap is? I'm going to show you. What's my company worth? How do I get an estimate of what my company's worth so I know what I need to increase the value by? And then how do I increase the value? Hopefully I'm going to answer all three of these. So the first one is I want to show you a very quick calculation on value. Has anybody heard of EBITDA? Good. Earnings before interest, taxes, depreciation, and amortization. Again, this is a very simplified example. So in this example, we have a company with net earnings of $409. We're going to add back interest, depreciation. We have no amortization. We do have to consider capital X expenditures. And then we have our EBITDA number. Then we have some normalizing items in there that shouldn't really be in there. So we end up with a normalized EBITDA of $350. If we take that $350 and we use a multiple of 3.5, we're saying that the company is worth about $1.575, assuming no debt. This is important to remember. If you have debt in your business, you should really focus on those 5 to 7 years before you sell it to pay down that debt. Very important to get that debt paid down. Because if you walk away with proceeds, you're going to pay the debt down with your proceeds. You might as well use the company money to pay that debt down before you sell. So this is simplified. If we can bring the income up or the EBITDA up to $650, so it's $150,000 more than we were, that actually increases the value by $525 because we have to take that and multiply it by whatever multiple we're using. So hopefully everybody followed that. So now, what if we can take that 3.5 and we can make it a 4? Very small movement on the meter there, from a 3.5 to a 4. Now our value's up $825,000. Pretty significant difference. So you really want to focus on what can I do to get that multiple up? And I'm going to show you some ways you can do that. So a lot of people have thought in the past that there's one way and I'm going to earn more money. I'm going to have higher EBITDA. Yes, that helps. But there's actually 8 ways that you can increase that multiple to bring the value up. And I'm going to go through these 8 ways. So the first driver is financial. The financial driver is probably the easiest driver for everybody to understand, but I can tell you it is the hardest driver for people to deliver on. Because financial doesn't necessarily mean only top line revenue, bottom line sales, being more profitable. It's also about accuracy. Have you ever heard the impression, or have you ever heard the saying, you can't make a first impression twice? That's kind of what your financials are. If anyone has gone through a buy-sell, the first thing a buyer is going to ask for is your financials. You want to make darn sure that those financials are accurate, that you understand them, you know what your margins are. You want to make sure that if you have departmentalization in your company, you are properly segregating that and you have departmental statements. I talked a little bit yesterday in our presentation about an electrical contractor client that I have that does commercial and new construction electrical work, and he also does service work. We have segregated that. So we have the service in a totally separate department, separate gross profit, separate net income. We're really monitoring that from the construction. Because if you were going to take that business to market, a multiple for construction company is about a 1 to a 1.5. The multiple on a service company, he can get probably 5. Huge difference. If we were to put that all in one pool and blend it, it's not going to accurately show what that business is worth. And he might decide, I only want to sell a portion of it. I'm going to keep the construction. I'm going to work really hard at making that profitable, but I'm going to sell the service piece off. So it's really important to make sure that you have that separated. Because remember, if a buyer looks at your financial statements and they start to question something doesn't look right, they're going to start to question everything. Everything they look at in your business, they're going to go, oh, I don't know if they were taking care of their business. You know, they didn't know this, they didn't know that. And make sure that you have multiple years. They're going to look for trends. You want to make sure that you have a 50% margin in one year and you had a 20% in the next year. You have to know why. You have to be able to explain those things. The second is growth. Now, growth is not only about growth in revenue, but it's about capacity. So believe it or not, a company that is only at 25% capacity is worth more than a company that's at 80% capacity. Because somebody wants to come in and they want to grow that business, especially if they have really good processes and systems in place. They want to go in and they want to take those processes and they want to replicate them in your business to grow. If your business is already at 80% capacity, 90% capacity, it's going to be very difficult for them to do that. So I want to tell you a quick story. I also like to tell stories. So I want to tell you a quick story about a client that I had that was looking at buying a customer, and this actually falls into one of my other drivers. They were looking at buying a customer because the customer had a product that they needed. My client was a distributor. They were selling, a supplier. They were selling that supplier's product to their customers, and there was a patent on it. This particular supplier wasn't doing so good, and they were going to be going out of business. So my client stepped in and said, I want to buy your business, because he really wanted that product. He had great systems in place. So we did some due diligence for them. They were down in Iowa. We went down to Iowa. We looked at the manufacturing facility where this product was made. We talked to the owner. We found out that the one piece of equipment that he was using to make this product that was custom built and cost over $2 million to build, he was in a little manufacturing facility, probably as big as this office, and this equipment took up about 80% of the space. We found out that that equipment couldn't be taken down and rebuilt somewhere else because of the product that he was making with it did something to kind of blend some of the pieces together. So he couldn't take it down. So basically they were at capacity right there where they were. That equipment couldn't move. we went back, and the owner just kind of casually mentioned this. It wasn't in any formal discussion. It was in touring it. So we went back, I went back and told my client, and he said, forget it, I don't want it. Because he was thinking, I can take that machine, bring it back to my, 200,000 square foot facility, and I can crank out 100 times what this guy's doing. Well, guess what? He was at capacity. My client was not interested anymore. He was going to find another way to get a similar product. So capacity is important. Revenue is also important. And I actually have some handouts. I didn't get this in our presentation. But there's only 6 ways that you can grow revenue. So I don't know if anybody's ever heard the hunt, farm, some of those things. So basically, you can sell the same product to the same customers, which is increase your market share. You can sell new products to the same customers. You can sell the same products to new customers. You can buy market share by acquiring another business. So I have this handout if anybody's interested. It's kind of good to take a look at it and figure out what you can do to increase your revenue. Oops. Okay, so our third driver, independence, also call this the Switzerland structure. Anybody know why we call it the Switzerland structure? Switzerland is neutral. The Swiss foreign policy has prided themselves on being neutral, being one of the only countries to not enter in any war since 1815 when they signed the Paris Treaty. They want to remain neutral. It's really important in your business that you're neutral, but here's where it gets interesting. Most people think neutral means neutral to customers. It also means neutral to vendors, suppliers, and employees. So in this value building process that I do, we talk about 20%. There's kind of this hidden 20% rule that you never want to have more than 20% in any one of those areas. Now, there are exceptions. I will tell you without a doubt there's exceptions. One of them is the construction industry. I have a lot of home builder clients that happen to get really good rebates from their lumber suppliers, that if they buy so much lumber from them in a year, they get rebates. Those rebates can be up to 8%. So you really have to balance that on where's my independence, and if you do have a dependency on a supplier, make sure that you have a backup plan. Make sure that you have somebody sitting on the bench on the sidelines. You never go to a football game and see nobody sitting. You always have a second string, a third string. You have people ready to come in, step in, if something happens. You want to do the same thing with your business. You want to make sure that you have a backup supplier or you have a good mix in customers, that if you lose one of them, you can continue to operate. Working capital. We also call that the teeter-totter because it is literally a teeter-totter of cash flow. So an example of that is, let's think about payables and receivables because it's something easy for everyone to think about. Is it possible that you can collect the money from your customers faster than you can pay your vendors? Because then you have cash for longer. If you're flipped and you're having to pay your vendors before you get paid, that's cash out of your pocket. That's called working capital. Or if you have too much inventory, you have too much inventory sitting in your warehouse that you have to wait to get paid for because you're holding too much. If a buyer comes in and they see that, they're actually going to take that down. That's not good because that means that a buyer has to come in and they have to put working capital into the company that they buy just to get it going. They need that initial kind of startup money. But if you have a good balance in your cash flow, then that's not needed. Performance driver number 5 is repeat sales. I kind of challenge anyone in any industry to figure out a way to get some type of reoccurring revenue. Reoccurring revenue is king when you're looking at multiples. If you have a business that has a steady flow because you're selling something automatic or it's reoccurring, that is fantastic for your business. A lot of people think, well, my business can't really do that. I kind of disagree. And you know, I've seen some businesses get really creative in how they do that. I'm going to give you an example of a florist. There's a florist, I think they're in Washington, D.C., that two young guys came in and bought this florist for a pretty low multiple because they didn't have a lot of recurring revenue other than they had the holidays, Mother's Day, you know, Father's Day, maybe birthdays when people were buying. But it was just those particular days. They didn't have this whole calendar where they had this steady stream of income coming in. So they sat back and they thought about, where else do we see flowers, plants? And they went around to all the local businesses, the restaurants in their area, and they said, for X amount of money a year, I'm going to come in once every 2 weeks, and I'm going to supply each table at the restaurant with fresh flowers. They went to hotels. I'm going to supply a nice centerpiece at the reception desk once a week. I'm going to come in with fresh cut flowers. I'm going to go to businesses. At SVA, we tend to have at our reception desk, we always have fresh flowers. I'm going to go in and I'm going to tell them that I can offer this. Well, guess what the value of that business went up to? These two guys that started this business bought it for probably $200,000. A couple of years later, it was worth over $6 million. Just great success story of what they did. Control. This is actually my favorite, and it's because of this differentiation. So what you want to do is you want to figure out a way to make your company different from the competitors. What do you offer? If you don't have a proprietary product, and some people don't, we in the accounting firm, we're kind of compliance driven. We do tax returns and we do audits. But we also do things like what we're doing today. We do succession planning, we do consulting. So you have to think about a way that you can differentiate yourself. Because if you can differentiate yourself, you now have pricing strength. You can charge more than the same type of business down the road because you're doing more. You have this differentiation. You have control over that. And in the example that I used earlier about my client going and trying to buy their supplier, well, kudos to that little supplier because he had control over my client, that my client was willing to buy his business just to keep that product coming. So I want to tell you another story that I find kind of interesting. It's about laptops. So years ago when laptops came out, you had some major manufacturers out there. So you had Dell, which their big punchline was they were customizable, build your own laptop. Then you had Apple, which was sexy at the time. Everybody wanted an Apple laptop because they were sexy. And then you had HP, which always talked about innovation. So you had Panasonic coming into the market of laptops, and they said, I can't compete against these guys. I don't have anything different to offer than what they're offering. They all have a tagline, I don't have anything. So they actually went out in the market, and they really looked at what was missing in the area of laptops at the time, and they found that the one thing that they were all missing is they weren't rugged. People were trying to get smaller, thinner laptops, something I can fit in my bag. And they said, you know what? I'm going to make a laptop, but I'm going to make one that's rugged. I'm going to make one that a salesperson can take in and out of their bag and throw on the airline cart and not break every time they open it. Or that police cars can put in their vehicles. So they came out with the Panasonic Toughbook. And I can tell you that a lot of police departments still use those laptops in their vehicles because they have to be able to sustain high speeds going over bumps, and they need to be reliable. They need to know that they can access them at any time. My son happens to be a police officer, and he showed me his car, and he has a laptop right there next to him. So that's really important. Loyalty. We talk about the loyalty that your customers have to you, and a lot of people don't know. So we use something called the Net Promoter Score. Highly recommend it for everyone. Basically, it's one question. You ask your customers, how likely would you be to refer my product or services to your family or friends? They answer between 0 and 10. You have detractors, you have passives, and you have promoters. Only the 9s and 10s are promoters. 0 through 6 are detractors. 7 and 8s are passives. What that means is the detractors are the people that are out there that are kind of hurting your reputation, saying bad things about you. The passives, they like you, but they're easily swayed. Somebody can come and say, I can do that service for 5% less. And they go, okay, because they don't have that connection to you. And then you have your promoters, your 9s and 10s, which are out there telling people about you. They're referring you to people. They're those really good referral sources, customers. You score it very easily. You take the percentage of detractors and you subtract it from the percentage of promoters, and that's your score. Highly encourage everybody to do this. You know, we always add a question at the end of it when we do it that says why. And we say it's optional because people tend to tell you if they've had a bad experience. They tend to want to talk about the bad experiences more than they want to talk about the good ones. So if you say why, they're going to be a little more likely to tell you why. And then that can be something that you really focus on in your business. And it's important that you are completely transparent with your staff on this, and you tell them, if you're a service business, you make sure they understand the importance of good service in your business. You know, maybe you have a 24-hour rule that every phone call has to be answered within 24 hours. You have to come up with things to be able to get that score up and make sure that that becomes a culture in your business of service, if that's the industry you're in, or product. You don't want to have product returned. You know, and maybe you can incentivize people that, hey, if we go a month without having any product returned, I'm going to buy everybody pizza. I mean, there's really little simple ways that you can do this. And then number 8, this is something that Nikki kind of alluded to a couple times in her pieces, and that's really making the owner irrelevant. All of this that I've talked about here is based on a book called Built to Sell. I don't know if anybody's read the book, highly recommend it. It talks about the owner being able to leave the business and the business still being able to operate. All about owner relevance. How do you do that? You do that through having a good management team. You do that through those golden handcuffs that Nikki talked about, and making sure that your management team is locked in with a good compensation plan. Do they have a bonus plan? Have they signed a non-compete or a non-solicitation agreement? Very important. A lot of people miss that one. Make sure that they have that signed. And a lot of times you can have them sign a non-solicit in conjunction with putting a bonus plan in place. So they can't just leave and go start their own business and take all your customers with them. So there's a lot of things you can do here, but you want to make sure that you are not the only one who can handle the day-to-day operations of the business. You know, I cringe when I hear business owners say, kind of like you said, haven't taken a vacation in 2 weeks. I'm working 16 hours a day. If I wasn't here, everything would go bad. Don't ever say that when you got a buyer walking through your business. You want to make sure that that business can run with the management team you have in place. I put together a plan for a client, and our very first meeting we said, John, what's your objective? And he said, I want to go to Mexico for 3 months. I don't care what you do or how you do it, but you figure out a way that I can go to Mexico for 3 months. And we did. And I have to say, he's gone right now. He won't be back for another month. And he is loving it. It took us a long time to identify management team, get a team in place, make sure we had the right profit centers in place, give everybody bonus and compensation plans to meet that. But he's been successful. And the business is doing incredible right now. So that's really about it with the 8 drivers. Whoa. Oh, I have a case study, but I'm not going to go through it because we kind of talked about a lot of it. So believe it or not, there's a score that you can take. There is a handout where you can put in your name and your email. If you send me those, I will send you a link to about 35 to 40 questions, they keep adding one or two, that then you're going to get a summary score. And I can tell you that the companies that have scored 80% or higher on this assessment have sold for more than 71% higher than their competitors. A lot. Now, not easy. You know, there's some meat in here that you got to really sink your teeth into. But if you can do this and you can take the time and commit to this, I can guarantee that you're going to sell your company for more money. I mean, there's research out there. This has been proven. So if you want to take the assessment to kind of see where you're at, you're going to get an overall score, and then I will get a report that shows scores in every individual area. And then you can start to develop a plan on what do I need to do to take those areas where I have risk and increase them. So now I want to talk really briefly about some funding risk. So we talked about selling to an insider, how do I fund that? And there's risk in that. The risk is that if you're offering seller financing, they stop paying you. You don't get paid. That's always a risk. Anytime there's seller financing, you don't get paid. Now, if it's to an insider, you can put some things in the contract that say if they miss more than 3 monthly payments, the stock reverts back to me. You know, you mentioned, Nikki, though, that you really don't want that. If you're selling your business, you don't want it back. So it is key to try to make them successful, but you have some safeguards in there that you can put in. And you really want to make sure that your employees buying in have some skin in the game. You know, that's really what it's all about. You don't really want to just give it to them. You know, we hear a lot of the word entitlement out there right now, and we just want to make sure that they work for it and they feel like they're working for it. So we have this analysis that we can do that we can kind of prove to you that once we know the cash flow of your company, we can look at what you're selling to them, and we can make sure that the payments paid to you, the company can fund those payments through S distributions. So this is a really quick example that I want to go through. So let's say we have a company selling for $600,000 for 5 years, and they're selling to 3 new shareholders 33% each. So we know, and I'm using a prime rate of 5, which I think is up now. It was like 5.25 the other day. I don't know what it is today, but we said 1% over prime, 1 point over prime, we're going to sell it to these guys for. So we said 6%, ran some amort schedules, and we said your monthly payment that you're going to have to make is $3,867, or you have annual debt service of $46,399 each. Well, now if you're the seller and you're collecting this money, keep in mind that because you're seller financing, you're getting the interest and not the bank. So I just wanted to point this slide out because you now have about $96,000 more in your pocket because you're financing it, not the bank. So kind of hear that people talk about there's a cost of risk. Well, there's a benefit of risk too. So this is your benefit to risk. You're getting a little more money. So now what we want to do is we want to back into that number and we want to say how much net income does a company have to make to be able to sustain those S distributions to those 3 shareholders. So very simple formula. I take my annual debt service from all 3 shareholders. Now keep in mind that whatever net income the company makes, I'm going to have to pay tax distributions on it. So I'm saying that those tax distributions are going to be about $62,000. So there's a little bit of a circular calculation here, but I know that the net income of my company has to be $201,000 in order to fund those S distributions. So I'm basically funding my own sale through the company profits. In this particular case, the company had normalized income of $353, and then when we ran a cash flow, which is basically adding back the non-cash items, depreciation, amortization, taking out debt service. There's another worksheet that we don't have in here. But we know that the net cash available was $361,000. So in this situation, no problem at all. Company can easily be able to fund that buy-in by those insiders. I've seen a lot lately where that margin's a little tighter. So then what we have to do is we have to push it out 5 years. I've had one that we even pushed out 10 years. Because you have the option. You can reduce your sales price to make your payments less. You can really figure out a way to get the company more profitable quickly. Or you can drag that payment out. And so in the situation I was working with, they chose to just drag that payment out a little bit farther. You know, one thing someone asked yesterday that we didn't really address is you can also do this if it's to insiders, kids maybe. You can do a combination of gifting and a buy-in. So it doesn't always have to be 100% buy-in. It can be gifting also. So that's the example I have. And now Nikki's going to talk a little bit about the tax implications.
All right, and sticking with the theme of we want to maximize our retirement income, that means that we would love to minimize our tax implications. So how can we do that? What are some things we need to think about? And let's go back to the key theme of this is planning. It doesn't just happen. There are things that you need to do intentionally to minimize your taxes. So what are some of the things we need to think about? You have voting versus non-voting stocks. So are you going to sell over time maybe a minority interest at a discount? What does that look like? You can have a non-voting interest as well. So non-voting is typically worth less than your voting, which would come at the end. Stock versus asset sale. So any seller wants a stock sale to maximize capital gains treatments, and any buyer wants an asset sale, maximizing the allocation towards personal property, so they can depreciate those assets quicker. So there's a disconnect there between what the buyer would prefer and what the seller would prefer. So you really need to look in your negotiations on what does this transaction look like. If it's a stock sale, that does have some beneficial tax treatments, but then you also need to consider what sort of risk goes along with that stock to the buyer. And what's the buyer willing to take on during that time frame? What kind of holdbacks are they going to require for that risk to minimize that risk? And then are those holdbacks too large that really, you're not comfortable with that risk? What's your business tax status? So we're here in 2018 and tax reform is all coming to fruition. Your business taxes are going to be lower this year. So we've probably all read in the news, we've read in the paper, we've talked to our advisors. If you're a C Corp, your tax rate's going to go down drastically. That was a pretty drastic reduction. But what that didn't take care of is there still is that double taxation on it. So is the C Corp really the way to go? You really need to look at that and say, well, is that double taxation might still mean that you're paying more in tax. So then do you look at, can I convert to an S Corp? But what you need to think about during this time frame is this all takes a lot of time to do it. So it's not like you can just switch overnight and then you get the beneficial tax treatment of the other entity choice. It all takes time. Gift and estate planning. So how can you minimize any estate tax implications? How can you maximize your gifting? These are all things you need to take into consideration. Now, I referred to earlier, the lifetime exclusion has doubled, but that might not be around forever. There's a lot of volatility in this in this lifetime gifting. So you need to take in the risk of that volatility and what does your estate plan look like, which Tim alluded to. And then retirement savings. So Jamie talked about, how do I make sure that I'm putting as much away tax-free, then pay the tax when you're in retirement. Your income will be much lower during that time frame. So how do you minimize the overall tax strategy? There's a lot to think about, and it's all very individual to every specific business is different. But the key is that it all takes time to plan accordingly. Now, Tim's going to talk to us about if our family is ready.
So one of the things to think about is we are talking about family business. So you really want to think about, is your family ready for this transition as well as you? And we think one of the neat things about SVA and SVA Plum as a team is that you don't have to share this information 7 different places. So usually on this type of relationship, Nikki or Nancy are the quarterback of the team, and at some point they want to bring us in as part of their team, other accountants, we have estate lawyers to kind of take a look at what you're doing, and you're sharing that information just one time with our group, which we think is important. And we build this plan, and what does that plan allow us to do? Well, for you, it gives you an aha moment of where I am, but it tends to be a great way to also communicate with your spouse and your family. You know, 89% or 79% of families have talked, as Nikki said, but what have they talked about is probably questions I don't know. Well, this can set give some clarity, some picture. And then finally, it's a roadmap. And Jamie, as our CAT engineer would say, when you turn one of these knobs, if this was a machine, and you turn this one, it affects the different pieces that go on here. So it's a roadmap that with your team, you can communicate and move forward. So there's a bunch of different areas in the financial plan. We actually hand you a financial plan that covers each of these areas. We talk about where you are and kind of how that area is rated, whether you're doing great or you need some improvement. We always talk about taking that stick and putting it in the road or the sand or the mud, depends what we're talking about. But one of the things that you can do is you can start out by doing your own inventory and say, where am I right now? And then we'll keep doing this inventory to figure out where you're at. And as Nancy said, probably one of the biggest one if you're sitting in this room is your business. What is your business worth? And where do those other buckets fill in? Taxes, I don't know if you know, but we have accountants in our business. They like to talk about taxes and tax planning. We think it's an important part. We think it's an important part not to think about next year's taxes, but 10 years worth of taxes. So we get the best return not just in 1 year, but longer periods of time. And as Jamie said, you know, can we fill up some of these other buckets? So if you deal with doctors, a lot of times what you find out is they've got a couple of houses, they've got a huge tax deferral bucket, and they got a little taxable account. Well, why is that not where you want to be? It's because the government owns a piece of that tax deferred account. You're going to have to pay taxes on that as you bring it out. So we believe in balance, and balance is if you can balance these different buckets out, you're going to be in a better situation. And you can see that a little bit. Jamie talked about it earlier, but this is just to reinforce. Remember, if our accountants can help us take money out at lower rates, that means we get a better after-tax dollar that we can use to fund what we're trying to do. And we think that's critical as you pull money from these different buckets to think about what's going on. And what you do before you hit 70.5, where you have to take required minimum distributions. We fill those buckets in different ways, and we think it's important to think about that part of it. Cash flow management, okay? How are we going to live? That's the number one question. How much money do I need, and when can I go? Well, we're back with Joe and Jane. They showed back up again. They've got a business. They're right here at 58 years old. They're thinking about, you know, can they retire or not? Should they wait till 62? Do they need to get to 65? We're just taking one little piece of what we're looking at, but one of the pieces we think that is important to look at is how much money do you need in your bucket to cover your medical expenses? Well, if you're fairly healthy, your bucket probably needs to be about $150,000 if you're going to retire at 58. The bucket needs to be closer to $250,000 to cover your health care expenses if you have some sort of issue. As you get towards 65, you can see that bucket gets less. So we've had relationships where we said, you know, let's get to 62. Let's use COBRA. Let's use your spouse's program. Let's do some things to make sure that this bucket, which you really maybe didn't plan enough for, is met. The other part of it, you have hit 65. Well, it still costs you about $500,000 to $1 million for the supplements, for the other pieces of your health care. And Jamie and I, we did a whole presentation about this, so we won't bore you with it, but you can really see between about $500,000 and $1 million just for cover this piece of what you're thinking about if you're going to retire early. And as always, there's a takeaway, and the takeaway is, you know, we just don't want them to break the bank.
Those numbers for a couple or for individuals?
Couple. They're for a couple. They're for Joe and Jane. The other part that we think it's important, if you think your buy-sell's dusty, I will bet you that your estate planning document is even dustier. And I'm a big advocate for one of the things we're going to cover here later. But again, let's go back to Joe and Jane 15 years ago, and that business was $300,000, right? Their net worth, they throw in the car and the house and everything, is $600,000. The kids are still back in school. All right, something happens to them. They get hit by the bus. Mom and dad are going to take care of the kids. Each of them get $200,000, and they can do with it to kind of grow their lives and move forward. But that's not the case now. Again, and we've been dealing with this on several different accounts, where this business is now $4.5 million, but their estate's $7 million. And there's people in this room that have this. They've got kids in the business again. They've got kids dependent on the cash flow of the business. And they've got kids that don't have anything to do with the business. And almost every time when we sit down with the couple, one of them in the business, one of them out, one of the couples said, usually the one not in the business, I want to be fair. Take this stuff and divide it by 3. Well, you can't really do that. So, you know, the person that's in California with 2 kids that's doing great research, that person maybe gets the house and the IRA, and the person that's in the business gets the cash flow. But we spend a lot of time talking about, what do you do with that child that has some issues? How do you build around that person to make sure that you protect the business, because that's key, but also help that child get through their life where they want to need it? And a lot of that goes to estate planning. And you can, this is one of the things that we use about, just like, I think it's a very simple way to think about who's in charge of what, right? And when's the last time this thing has been updated? And have you had a life event, or have you had something happen? So my deal is talking, I have kids that are in their 20s. My youngest one is 22 and going to graduate from the University of Notre Dame. Just threw that in for Ed. Anyway, but we have a medical power of attorney for him that says that his mother and I can actually find out what happens to him. If you've got children, what's the chances that you have medical power of attorney if they've turned 21 or even 18? We find, what, 20%?
If that.
If that. So I'm an advocate. Go out. It's an easy form to find, and make sure that you get some sort of medical power of attorney. I will tell you then that probably the last time that you had your will redone, the picture looked like this, but I also know that secretly people are sitting in here and you have no plan, because you've been working in the business, not on the business, and not thought about this for a while. Our part of this is these 2 documents, along with what the plan that we put in this transition, is fluid, right? So if you're meeting with Nikki and Nancy about business changes every quarter, maybe you brought Jamie in to help with the 401k. We're meeting every 6 months to talk about your portfolio and your tax situation. But that financial plan is coming in every 18 to 24 months, and that estate plan we're bringing up every couple of years, or we're looking at it almost every time, to make sure that it's meeting what we're trying to do, because you don't know when the bus is going to come by. So whoever you work with, you should really make sure that you've got a solid financial plan with a good team. Review your estate plan. Make sure you kind of define what your income needs are. Be realistic. We don't have enough time to talk about it, but you'll start in retirement up here, traveling, you know, buying a new car, living on a certain amount, and then your income needs is a smile. It'll go down into your 80s, and then it'll come back up right at the end of your life because of health care. So that's kind of how your spending actually goes. Plan for your health care, and then we like to think of ourselves as your dentist once you start, that we have regular appointments, and when you leave from your last appointment, your next appointment's already on the schedule. So that's how we look at it. We combine it with the team, and I know Nikki wants to finish up on a couple things that she thinks you should start with your planning part of it for the business piece of it.
Yeah, so we've gone over a lot. Where do you start, or where are you at? So really start at the top. Start figuring out, what are your objectives? What are your business and your personal financial resources? Once you have those 2 items figured out, then you can start boiling down with your professional team on, what do all the other aspects look like, and how is this all going to work for your specific business? And then in your handout, we have a little flyer, and you can go online. So we use a tool called BEI. So there's about a 20-25 question assessment. And it will give you, so if you fill it out, you can go online and take the little thing. Otherwise, you can fill it out and give it to us today. But it'll tell you, where are you at in each specific area of yours. So this one, you're going to see there's a lot of red. And in some of yours, there will be a lot of red. So initial panic. But what that tells you is you probably haven't thought about all these areas. So it gives you really areas to focus your thoughts on, focus your time on where do you begin, how far you've come, and then how far you have left to go in your exit. So now we'll take any questions that you have for any of us. Yeah.
Is there ever a combination of bank finance?
It's a very good question. So the question for everybody is there ever a combination of bank finance and seller finance purchases? And the answer is definitely yes. We would like to maximize the bank financing. That limits your risk. Again, then you don't get that interest. So what does that look like? How much risk are you willing to take on? And how much risk is the bank willing to take on? In every certain scenario, that's different. Every certain bank, that might be different. But that's something that you really need to work throughout your transition to determine what that looks like.
So just one thing to know, if your buyer was using SBA, the SBA requires this very small component of seller financing. So they've changed the restrictions a little bit starting in January of 2018, but you do need to have a small component of seller financing if they were doing an SBA loan. Well, again, they changed the restrictions because seller financing used to be part of the equity, and they would need so much equity down to fund it. And now they've changed that, and that the seller financing is no longer part of the equity. So depending on how much the buyer was putting down, so yeah, there's been a couple of changes, but they do require a small component. And the payments are always deferred too, so something to think about. It used to be 3 years. I don't know if they've shortened that, but for the first 3 years, they couldn't pay the seller. It was all deferred, and then after the first of the third year, the seller started to get paid.
Also, I'll just add, do some work on your banks, because you may think the bank that you're banking with is the right person, but a lot of times banks that finance businesses are very specific to the industry that they're working on. And you can really get better financing because you're selling a vet practice. And this business really understand it. Where your bank goes to the department, the lending department, they might say, we don't understand this stuff. So doing a little research to get to that point is really worthwhile.
Yes.
What is the success rate, failure rate, problems, issues where you have a key person who doesn't have financial resources to put anything in the game, but you would have a long-term workout where they were 10, 15 years experience? How much experience with that, and what are the results?
Yeah, so the success if you're selling to a key management team and they don't have a lot of experience, it may be a longer payout. Money, okay. So the key is, do they have the experience? So can they run the business, and can they grow the value of the business? And if you're very confident that those two answers are yes, then the success rate is much higher. If it's maybe a newer person and they're young and they don't have a lot of experience and you're hoping that they can get it, but you don't have that confidence, that kind of shifts the other way. So it's really to take time and to do some due diligence over your buyer when you're taking on that risk, and make sure that you feel comfortable that they can do it.
So
Go ahead, I'm sorry.
I just want to say I had a situation recently where I had a client. He was going to sell his business to his son and had a value all calculated and everything, and then started looking at the son and found out the son was 35 years old and still living in the basement of his dad's house. And we said, yeah, I don't think that's going to be successful. You got to have a little bit of tough love here, push him out. He's got to figure out, spread his wings a little bit, figure out how to be responsible before you just turn this business over to him and he's still living in the basement of your house. So you got to kind of look at who you're selling to and what their situation is too.
And I was just going to add, if you've got some time, get them some training. Get them to move themselves up.
These are experienced long-term employees.
Okay.
Yeah.
That's hard.
Yeah.
I mean, I could disappear tomorrow.
So then,
But they just don't have the cash to put up front. So
yep.
it would be a,
Buyout.
like a zero down loan.
That's very
long time.
typical. We see it every single day. We get calls, we get questions, we see it all the time. And if they can run the business, then your risk is much lower.
The business will pay for it in that example that I
Yes.
showed.
Yep. Yes.
Does SVA get involved in finding a potential buyer or work with companies that do?
We have a lot of business brokers that we work with. We do not broker. We're not brokers. Occasionally we'll have clients come to us and say, hey, do you know of anyone selling a small manufacturer? We may connect them, but we do not broker. We do not take any type of commission. We work with, in Milwaukee, we work with Sunbelt or Bridgestone Advisors. We have a lot of connections. So if somebody were taking it to market to an outside party, we might recommend that they contact one of those brokers. And then we work really closely with them, so.
Well, we will be around for as long as you guys want to talk, but before we leave, Bonnie Bailey and Jennifer Bruin in the back are the ones that made sure that this thing all happened and got set up. We just showed up with less than talent, but we'd like to give them a round of applause and say thank you very much. As always, they did a great job. Thanks for coming, and we'll be around.